Hall & Wilcox acknowledges the traditional custodians of the lands on which this podcast is recorded. We pay our respects to their elders, past and present, and to all First Nations people joining us today.
Hello, welcome back to our Equity Capital Markets podcast series focusing on all things ECM. Today we're talking about the topic of climate reporting in financial reports. I must admit, this is one of those topics I don't know much about. I do know there's a bill before Parliament. I didn't know what it was called, so I looked it up. It's innocuously enough titled Treasury Laws Amendment, Financial Market Infrastructure and Other Measures Bill 2024. So we'll just call it the bill for now. To help me understand it better, I'm joined by Susie Leask, a partner in our Newcastle office, and Savan Gore, a partner in our Perth office. Welcome to you both.
Thanks, John. Great to be here.
Well, let's just jump into it. So Susie or Savan, so broadly, what's the bill about and what's the status of it? How far has it got through the parliamentary process?
Thanks, John. So this is something that we've been talking about for a while now in terms of sustainability and climate. And we were very excited earlier this year to get the exposure draft. I know that's a really nerdy thing to say, but we do get excited about these things. And the bill has now been introduced to Parliament. It's currently undergoing debate as we record this, so it is a bit of a moving target. But look, it's a really interesting time in that this bill, it sets up the mandatory Australian climate reporting framework, essentially. Note we're talking about climate as opposed to other broader nature and sustainability related risks and issues. So specific to climate, we're talking mandatory disclosure reporting for heavy emitters, large listed companies and large private companies and superannuation funds and asset managers. So we do expect that those broader sustainability related disclosures will follow in due course. But as I said, this sets up the framework. So it is currently going through Parliament. And of course, the big question I think that everyone is asking is, does it apply to us?
Yeah.
Which entities does it apply to? How does it work? What do we have to do? And certainly in my corporate governance practice, I know a lot of directors are keeping a close eye on this. And certainly in the financial and professional services sector, it's being closely watched because this is going to really impact how organisations prepare their financial reports and even right down to the data that they collect.
Yeah. So who will it apply to initially? And when do we think it will come in?
Yeah, it's a great question. So the start date has actually changed between the exposure draft and the bill that was introduced into Parliament because it was coming up a little bit quick, originally proposed for the 1st of July, but it's now looking like the first group, because this will be phased in over time in 3 different stages. The first group will come in on the 1st of January 2025. So essentially, the way the bill works is that entities that are required to report or prepare and lodge annual financial reports under Chapter 2M of the Corporations Act, who meet certain size thresholds or have emissions reporting obligations under the National Greenhouse and Energy Reporting Act, the NGER, or are asset owners, such as registrable superannuation entities and funds with management of more than $5 billion, will need to be looking at what categories they fall into. And it's a difficult thing to explain on a podcast. There's a lot of numbers, but bear with me. If you can picture this in a bit of a table or sort of 3 groups as we break it down. So essentially the first group, the 1st of January 2025, group 1, will be required to commence their reporting obligations under the bill if they have, for example, consolidated revenue of $500 million or more, consolidated gross assets of $1 billion or more, or in financial year employees of 500 or more. That will also capture the NGR reporters who are above the publication threshold as well. And then the list goes on. So group 2 will commence from the 1st of July 2026. So those are large entities with $200 million or more of consolidated revenue, $500 million or more of consolidated gross assets, 250 or more employees, all other NGER reporters, and also a new class of asset owners, so who have $5 billion of assets under management or more. And then finally, that group 3 from the 1st of July 2027, who have $50 million or more in consolidated revenue, end of financial year consolidated gross assets of 25 million or more, or 100 or more employees. So you can start to see how many organisations this can potentially apply to.
Sure. And Susie, also, are you finding your clients are beginning to plan for that now, or is it something that's only barely on the horizon? Or
I think it's on the radar. I think it's obviously very new, and I think people were waiting really for that bill. As you do when you have an exposure draft, you kind of almost wait for the legislation to get through and see what format it gets passed in and the exact final thresholds and dates that come into effect. It's more, though, when we think about best practice corporate governance and how organisations are approaching their director duties and the various risks and liabilities around climate and nature and sustainability and ESG more broadly, whether that's talking about greenwashing and aspirational statements that they might already be looking at doing. I think it's coming up in that context. We have a lot of clients who are obviously trying to lead the way and would like to lead the way in that regard. And I think you do have to really think ahead, because the data you're collecting now, the information you're gathering, is going to help you prepare some of those reports.
Just on your previous question, I think a lot of some of the larger companies and clients are already, reporting, they prepare sustainability reports which do touch on and cover climate change. And so the exercise for them at the moment is working out, what additional reporting do we now have to do? What additional systems do we have to put in place to make sure we comply with these new standards, which, as Susie mentioned, is sort of an evolving concept as submissions are being made and feedback from the consultation process is being taken on board and either, implemented or not.
And what form of disclosure are we talking about? Is this like a once a year?
Yeah, so it's an annual requirement, and it will form part of entities' annual reports for those entities that are required to comply. There'll be a separate section in the annual report where you'll effectively have a sustainability report which will sit within the annual report, and that in itself will have certain required prescribed information that needs to be included. Some of the key features will be around what your climate risks are, how you are addressing them, the systems you have in place. There's also sort of analysis, I guess, that needs to be done in terms of the potential risks and how they might play out. So some sort of form of, I guess, modelling, if you like, to give examples of what your future state could look like.
And is this part of the company's audit program?
It's a great question, because there's no the sort of mandatory audit requirement of the sustainability report doesn't kick in straight away. And so there is a gap between mandatory assurance or auditing of the information in the sustainability report and when the actual application to prepare this report kicks in, which obviously presents a problem for directors, because they ultimately have to prepare and sign off on a director's declaration certifying the information in that report, and they would be doing so potentially without that underlying assurance. And so I think from a practical perspective, what you'll see is entities looking to still go and get their reports audited, or getting some degree of review or assurance to give them the confidence to be able to make those statements in the declaration.
And audit assurance from the financial auditor?
So there will be the auditor, but there'll also need to be experts who will need to be involved, as well, in order to ensure that, from a technical perspective, what you're saying is actually correct, and there is a reasonable basis of doing so.
That's such a great point, Sivan, and I think all of our director and board clients who are grappling with this are trying to figure out how they get that information, essentially. And I know the content requirements are a little bit up in the air and under development at the moment, but I think the challenge will be around that director's declaration Absolutely, given that if you're effectively signing off to say you've taken reasonable steps to ensure that the substantive provisions of the sustainability report are in accordance with the Act, how do you do that if it hasn't been audited? Or what information and expert reports are you basing this on, given that it is so new and it might be entirely new for that particular company, so they might have a data gap. And I know there's organisations out there that are literally working on that now in readiness for filling those gaps, and so they have content to put in. And it's not that they're not doing things, so often it's, they are doing, or they do have the relevant information, it's just not readily available or to hand or organised in a way that, because they haven't had to technically report on it before. Although Sevan's quite right that you often find organisations who are doing that naturally already. But again, how far do you even go with these statements and these reports when you don't want to go so far as to be aspirational and to be accused of greenwashing or misleading or deceptive to statements as well?
I mean, it's interesting. I mean, the need for mandatory assurance of that information, and that's quite a radical change, isn't it, in terms of the content of companies' annual reports?
Yeah, I think it's a huge change in terms of there's a whole category of information that you now have to pull together and report on and sign off on as a director. And I appreciate that there will be a modified liability regime as part of the new bill, but it doesn't cover everything, and it's not entirely giving you kind of sleep at night comfort as a director, I don't think.
Well,
and
maybe
you'd be wanting to be really careful.
Yeah, let's just jump straight to that. So which is obviously in some ways of most interest in it, is what the teeth are, particularly for directors. So just briefly, what are the potential liability consequences for directors of breach of the assurance requirements?
Yeah, and this is the interesting part, in that the policy intention is, of course, for this to be phased in and to be introduced so that ASIC can help educate people and encourage reporting and encourage compliance. And they do have this modified liability regime over the first 3 years. So transitional provisions essentially that provide that liability for misleading and deceptive or other conduct in relation to the most uncertain parts of climate statements are temporarily protected, but it's a limited immunity. So it only applies to certain types of statements. So, for example, a statement within a sustainability report prepared for a financial year during those first 3 years, and about scope 3 greenhouse gas emissions, which are obviously a little bit harder than the others, to make clear statements about scenario analysis made in those sustainability reports, or a transition plan, for example.
So it's really something to keep an eye on, this, isn't it, over the next 12 months, 18 months, 2 years?
Yeah, and I probably, as a director myself, I probably wouldn't be relying on modified liability regimes. You kind of want to get it right, particularly given that they're not all encompassing. And I think, as I said, it's not ideal when you're signing off on these things as a director. You do certainly have that pause of what's in this, and where is it going, and can we really make these statements?
Yeah. So, Savan, maybe a final word from you on the director liability point. What are you starting to say to your clients about how they should think moving forwards?
Yeah, look, I think the sort of internal reporting and systems that are in place, to capture the data, to properly understand the risks, and being able to call on the right experts to assist is really important, because ultimately you're going to need a reasonable basis to be able to sign off on these declarations. And if you're not getting the full assurance, then how else are you sort of satisfying yourself, that you're making an informed decision and call, and are the systems in place robust enough to be able to demonstrate that to a regulator, if you're ever sort of called on to justify your declaration.
I was going to say, I'd just probably add to that to say it's probably a really good idea to start early rather than later. Obviously, step one is to figure out whether you're covered by the relevant group, so which group you fall into, and then when you have to start reporting officially. But I would be starting early in terms of pulling the information together, and if you're not covered this next financial year, for example, you might do a bit of a dummy run because as Sevan says, and as certainly lots of colleagues that I work with in this space will say, is that data, that collection, that being ready and ahead of the game, whether it's climate, sustainability or nature-related risks, I think is what will put companies and boards in good stead.
Yeah. Well, thank you both. Certainly want to watch. I've learned a lot. And thanks also to everyone for listening today. As always, please get in touch with us if you have any questions. You can find our details on our website, which is hornandwilcox.com.au, or connect with us on LinkedIn. If you enjoyed today's episode, then please rate, review, or follow our podcast wherever you get your podcasts. Thank you.
This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.